Hi there, in this video we'll compare company cars and EV salary sacrifice using benefit-in-kind calculations to help you understand the tax differences.
Welcome to this explainer. I'm a tax advisor from Atlas Tax Advisors, or ATA for short. We're a UK accounting firm, and our whole world revolves around helping businesses actually understand tax compliance and navigate those tricky HMRC regulations. Today, we're diving into a topic our advisory team has prepared for you: company cars versus salary sacrifice EVs and the side-by-side benefit-in-kind maths here in the UK. If you're a UK SME owner or a company director managing staff in a fleet, we are looking at a massive financial opportunity for the 2026/27 tax year. The tax landscape has completely shifted under our feet. What used to be a completely standard executive perk can now literally be a financial black hole. But on the flip side, modernizing your approach can save your business and your team thousands of pounds almost overnight. So let's just jump right in and look at how this works in practice.
Here's a scenario that plays out in boardrooms across the country pretty much every single day. A company director or a key employee needs a new vehicle. So, out of sheer habit, the business just leases a traditional petrol or diesel company car. For years, the petrol 3 Series or the diesel Audi was just the default executive choice. It was just what you did. But I have to ask, are you unknowingly triggering massive personal tax bills and heavy employer national insurance burdens by doing this today? This is something a lot of taxpayers only discover when they're reviewing their tax position at the end of the year. And honestly, by the time your accountant flags it, the financial damage is already done.
To really put this into perspective, look at this number, £5,580. That is the shocking annual income tax bill a typical 40% higher rate taxpayer could face in the 2026/27 tax year simply by choosing a standard £45,000 petrol saloon as their company car. And keep in mind, that is a post-tax deduction. That is money coming straight out of their net pay year after year, literally just for the privilege of driving a standard combustion vehicle. That means your employee actually has to earn significantly more in gross salary just to clear that tax bill. And frankly, that doesn't even factor in what the business is paying in national insurance on top of it.
At ATA, we treat this pivot away from traditional vehicles as a core, fundamental boardroom strategy. So think of this explainer as a high-level consultation just for you. My goal today is to show you exactly how to pivot away from those punitive tax charges using the 2026/27 tax rules, specifically through electric vehicle salary sacrifice schemes. We want to empower you, as a business leader, to maintain strict tax compliance while executing some incredibly smart financial planning that benefits both your bottom line and your team's morale.
Okay, let's look at the stark reality of HMRC's current strategy. The government is actively using the tax system to aggressively push businesses towards zero-emission transport. For the 2026/27 tax year, the benefit-in-kind, or BIK rate, for a fully electric vehicle is locked at just 4%. Compare that to a traditional high-emission petrol or diesel vehicle, which can easily attract a crippling BIK rate of 31% to 37%. That single percentage gap is what drives this entire conversation. It's a deliberate, structural incentive designed by HMRC, and honestly, ignoring it is frankly just leaving money on the table.
And as you might expect, the market is reacting exactly as it should. Recent data from the BVRLA vividly illustrates that salary sacrifice for EVs is absolutely skyrocketing. We're talking 125% year-on-year growth. Smart businesses are waking up to this exact tax gap. They realize they can offer their staff a brand new car, fully insured, maintained, and serviced, while actually lowering their payroll tax liabilities. Think about the real-world value to the employee here. No unexpected repair bills, no separate insurance premiums to hunt down. It's all bundled together. This is not just some niche perk anymore. It is rapidly becoming a standard business strategy for talent retention.
Now this is where many people become confused. You might be sitting there thinking, wait a minute, didn't HMRC close all those salary sacrifice tax loopholes a few years ago? Well, yes, they did, with the optional remuneration arrangements, or OPRA rules. Let's break this down really clearly. Normally under OPRA, if you sacrifice salary for a benefit, HMRC taxes you on whichever is higher, the cash you gave up or the value of the benefit itself. They designed this to stop tax avoidance. But here is the critical, deliberate exception. Ultra-low emission vehicles, specifically those emitting 75 grams per kilometer of CO2 or less, are entirely exempt from OPRA. Because of this specific carve-out, you are taxed solely on the 4% BIK value of the electric car and not on the much larger chunk of salary you gave up to get it.
Let's actually walk through the side-by-side maths and see how this builds in the real world. Let's take a close look at a Hyundai Ioniq 6 EV with a P11D value of £44,000. Now compare that against a comparable BMW 3 Series petrol saloon valued at £45,000. For our 40% taxpayer, the EV generates a BIK value of just £1,760 because it sits at that ultra-low 4% rate. This results in an annual income tax bill of only £704. Now look at the BMW. Because it falls into the 31% band, it creates a massive £13,950 BIK value. That costs the exact same employee £5,580 in tax every single year. And let's look at the employer side, keeping in mind the Class 1A national insurance contribution rate of 15%. For the EV, the employer pays just £264. For the petrol BMW, the business pays a staggering £2,092.
So what's the crucial takeaway for your bottom line here? By simply choosing the electric route under these rules, the higher rate employee walks away with an extra £4,876 in their pocket every single year compared to the petrol alternative. Simultaneously, the employer saves £1,828 in Class 1A national insurance per year per vehicle. The combined power of both the employee and the employer's savings simultaneously is immense. I mean, if you scale that across a fleet of 5, 10, or 20 vehicles, the cash retention for your business is absolutely transformative. Did you know, under HMRC's Oprah exemption, you are only taxed on the 4% BIK value, not on the salary you gave up? This is the exact mechanic that makes the whole thing tick. Because of that Oprah exemption, the employee's sacrificed gross pay is legally protected from standard taxation. So, if an employee gives up £8,400 of their gross salary a year to fund the EV lease, they don't pay 40% income tax or 2% national insurance on that £8,400. That money literally vanishes from their taxable income entirely, replaced by that highly efficient 4% BIK charge instead.
Let's quickly walk through the actual flow of funds step by step so you can see it in motion. Step 1. The employee agrees to reduce their gross pay in exchange for the vehicle. Step 2. Because their official gross pay is now lower, their income tax and employee national insurance drop immediately. Step 3. The employer also calculates their national insurance on this new, lower, post-sacrifice salary. Because the salary base has shrunk, the business inherently saves money. Step 4. The 4% BIK charge is applied to the employee's tax code. It's a win-win scenario. Everyone wins. Well, except maybe the tax man, but we're okay with that.
Let's focus heavily on the business owner's perspective for a moment. 15%. That is the employer Clause 1 national insurance contribution rate for the 2026/27 tax year. Whenever your employee sacrifices a portion of their salary for this scheme, you, the employer, do not pay that 15% NIC on the sacrificed amount. So, if an employee sacrifices £6,000 a year, the business saves £900 in national insurance outright. And remember, that is £900 saved per employee per year. Scale that across multiple staff members, and the operational savings are highly significant.
Which brings me to a professional tip from our team at A2P. A lot of business owners worry about the administrative costs of running these schemes. It sounds complicated, right? But you can strategically use that 15% employer NI saving we just talked about to cover the platform fees of a scheme provider. Many of our clients find that the national insurance savings completely offset the administration costs, making the entire EV benefit scheme completely cost neutral to the business. You are offering a massive, life-changing perk for essentially zero net cost.
Now, a really common question we get is, well, what if the government changes the rules halfway through my lease? Thankfully, HMRC has provided absolute financial certainty here. They have mapped out the EV BIK rates all the way through to the end of the decade. The trajectory is crystal clear. It remains at 4% for 2026-27, rising gently to 5%, 7%, and capping at 9% in 2029-30. Even at 9%, it's still a tiny fraction of the tax applied to petrol cars, giving you total confidence to sign a 3 or 4 year lease today without any fear of a sudden tax spike.
Of course, out in the real world, things change. What happens if a key employee leaves the company? Or what if a director doesn't want a fully electric car and insists on a plug-in hybrid vehicle, or PHEV? These are entirely valid practical concerns, and honestly, they're the exact hurdles that stop a lot of SMEs from pulling the trigger on these fleet upgrades.
Fortunately, the market has matured to handle this. Firstly, modern scheme providers build early termination insurance directly into the monthly lease cost. So if an employee leaves, resigns, or faces redundancy, the business isn't left holding a massive lease liability. The insurance covers the vehicle's return. Regarding hybrids, yes, they are an option, but be warned. PHEVs carry much higher BIK rates, ranging from 6% to 19% depending on their electric range. Plus, and this is crucial, if a hybrid's emissions sit at 76 grams per kilometer or higher, it does not get that magical opera tax exemption. It immediately falls right back into the punitive tax trap where you're taxed on the higher of the cash given up or the benefit.
They can still be good cars, but they just aren't the tax superheroes that pure EVs are.
Here is another professional tip for staying compliant. Always update HMRC mid-year if a car changes to ensure accurate P11D reporting before the July 6 deadline. For directors who might usually leave this to their accountant, the P11D is the statutory form used to report benefits in kind to HMRC. Keeping clear records will absolutely save you from major compliance headaches later. Always update HMRC mid-year if a vehicle is swapped, returned, or added. The P11D reporting deadline is the 6th of July following the end of the tax year, with the Class 1A NIC payment due shortly after. HMRC has become very active in penalizing late or inaccurate P11D submissions, so accurate payroll integration is absolutely vital here.
So, we come back to you. Are you, as a business leader, ready to turn a costly tax oversight into a profitable pivot for your business? You've seen the maths. You've seen the £4,876 annual employee saving and the 15% employer NIC retention. The gap between doing things the old way and leveraging the 2026/27 tax rules is simply too large to ignore. It is a highly profitable, talent-retaining pivot just waiting to be actioned. Thank you so much for joining me today. Please remember, this explainer provides general guidance on UK tax rules and should not be considered as professional advice. Individual circumstances differ widely, and professional advice should always be obtained before making financial or leasing decisions. If you want to see exactly how these numbers apply to your specific payroll and fleet, please contact us at Atlas Tax Advisors for personalized advice. We'd absolutely love to help you optimize your strategy.